As we wrap up our discussion of financial accounting, I want to leave you with a few broad concepts that will help set a foundation for the study of financial accounting when we get together in the classroom. There are some basic assumptions. Now, one of the assumptions is economic entity. In other words, we know what entity we're reporting. Okay? And that might seem like really obvious and basic, but understand that sometimes there could be multiple companies that are combined into a set of consolidated financial statements, for example. We also need to understand that the business itself is a separate economic entity from the owners and from other entities. So basically, we need to identify what is the economic entity for which we are gathering financial information, aggregating it, and then reporting it to people who are making decisions. Going concern. With going concern, we assume that the business will continue indefinitely. Now, of course, you guys have seen businesses that failed. You can probably look around your own neighborhood or businesses that you've encountered over the years, and some of those just don't exist anymore. But for financial accounting, we're going to assume, we're going to be optimists and assume that the business will continue indefinitely. That allows us to measure things like accounts receivable. Accounts receivable would be pointless if the business didn't continue to exist. We need to assume that the business will be here next year and the year after, et cetera, et cetera. If we don't have a going concern, then we actually have to switch our reporting to something called the liquidation basis of accounting. That's a whole different topic. So we'll keep going concern. We'll be optimistic. Historical cost. What this means is that for the most part, we will measure financial statement amounts at what we paid for a transaction. There are a few times where we will deviate maybe and measure something at fair market value, but for the most part, historical cost is objective, it's verifiable, it's not debatable. We know if we spent $40,000 to purchase an oven for our restaurant, that's what it cost. Now, what is it worth today? I don't know. We'd probably have to get an appraisal done or something like that. That's why measuring things at the fair market value, there's more subjectivity involved. And for the most part, United States generally accepted accounting principles require us to measure things at what we paid for them, historical cost. That is different. There are some different guidelines when we get to international financial reporting, and there are some exceptions with the United States GAAP, but for the most part, historical cost is the rule. Time period. Very simply, we need to know the time period for which we're reporting. Is this an income statement for the month, for the year, for the quarter? Is it something just measuring a particular week or day? We have to be able to take the activities of a company and artificially break them up into chunks for reporting purposes. And then finally, monetary unit. We need to pick one. Is it the US dollar? Is it the euro? We just need to choose a monetary unit and consistently apply that monetary unit. A few other concepts. Financial statements should be consistent. So in other words, within a company from one year to the next, from one period to the next, we should be operating by the same rule book, the same accounting principles, so that we can compare one year to the next within the same company, right? Consistent application of accounting principles. Comparability might sound a lot like consistency, but what we're talking about with comparability is comparing different businesses and trying to make sure that they're operating by the same rule book. For example, let's say you were going to compare Lowe's, Home Depot, and Menards. 3 home improvement stores, same industry, really selling similar types of things. Well, if we want to compare the financial performance and the income statement, the balance sheet, and other elements of financial performance, we really want to make sure that Menards and Home Depot and Lowe's are playing by the same accounting rule book, US GAAP. Now, so we try to encourage that comparability. there are plenty of opportunities for discretion, even within United States GAAP. For example, maybe one of the entities uses last in, first out for inventory. The other one uses first in, first out. Could be that one of the entities depreciates equipment over 7 years. The other one does it over 5 years. Okay, so we do need to understand the differences in order to be able to make comparisons between companies as we evaluate their relative performance. Financial information is supposed to be relevant. In other words, it's supposed to provide meaningful information for whatever decisions that users are making. Okay, whether that be a lender or an investor, whatever decisions they're making. And a lot of times it involves future cash flows. Think about it. If you lend money to a company, you're primarily concerned with this question: can they repay the loan with interest? So let's make sure the financial statements give relevant information to help answer that question. And I guess it goes without saying that financial statements should be reliable. They should be accurate. Conservatism. This has nothing to do with how you vote in political elections. Okay? What it means is if all other options are equal, we're going to present the least optimistic view. Now, don't misunderstand me. We're not going to make the financial statements look purposely bad. That's not the concept of conservatism. But if we have two equal options and one presents a little bit more optimistic picture and one is a little bit more pessimistic, we're probably going to go with that more pessimistic, because conservatism basically means we don't want to overpromise and underdeliver. We would rather underpromise and overdeliver. We don't want to paint too good of a picture. And then finally we have materiality. Now, materiality basically means, is it big enough to matter? Something that is material will affect the economic decision of an informed decision maker. Materiality could be a dollar threshold, but it also can be in terms of qualitative considerations. So take this for example. It's possible that, let's say you run a small restaurant, maybe a $10,000 or $20,000 error in the financial statements would affect your impression of that business's operations. Okay, but $10,000 or $20,000 would be nothing to a large chain like Pizza Hut or McDonald's or Burger King. Okay, a $10,000 error in financial statements of McDonald's would be unnoticeable. It wouldn't impact anybody's impression of the company's performance. So materiality can be expressed in terms of quantity, so in other words, magnitude of dollars, but it also could be qualitative. What if you had a dollar amount that was quantitatively immaterial? In other words, it's so small, it really doesn't matter, but it was just enough to turn a net loss to a net profit, or maybe it was just enough to allow a company to meet a financial ratio that is required by their bank to keep their funding in place. That's an example where something that is quantitatively small could end up being material because it impacts the decisions of people who are making choices about this entity. Finally, frameworks. We talked a little about United States GAAP. There are financial reporting frameworks that we will use. Probably most commonly US GAAP is what we'll talk about. International standards can come into play, but there are other frameworks as well. They're less commonly used, but they are options, especially for small businesses or for particular circumstances. Ultimately, what we want to do with external financial reporting is to be able to use this information to make decisions. One of the major things that we're going to explore throughout the semester is how do we use the information from financial statements to make decisions. We'll go into it in detail in the classroom, but I want you to understand that there are three broad categories: profitability, liquidity, and solvency. So we want to be able to use financial information to analyze, is the company generating a profit? If it is generating a profit, is it the right amount of profit? Just because you're making a profit doesn't mean that it's good enough. Are there opportunities for improvement? Could you enhance your profitability? We will learn how to use financial information to answer these questions. Liquidity. Will the company remain in business within the next year? Liquidity, a liquid asset is one that flows easily, like a liquid. Cash is the most liquid asset. If you need to pay a bill, everybody accepts cash, okay? So when we think about liquidity, what we're really doing is we're assessing the short-term health of the entity. We're going to learn techniques that we can use to analyze the short-term health of the company. Will it be in business within the next year? What's the likelihood? Then solvency. Solvency is the long-term health of the business. Will it be in business 5 years, 10 years, 15 years from now? We'll learn techniques for analyzing that as well. This is where we're going to head in the semester, is not so much the bookkeeping. We'll do a little bit of that, maybe some transaction analysis. But what we're really going to focus on is how do we use this information to make decisions about the health of an organization.